Now we're going to turn to the real estate market and looking at consumer expectations, because if you're expecting something, then you may be more likely, less likely to buy a home, at what price, and there's a lot of these pressure points that we want to talk about. So when we look at the the Conference Board inflation expectation over the next 12 months, you can see that has shifted up to about 6.5%. There's a lot of fears of just where inflation is going to be over the next few months. And I think that's clear based on what we're seeing in the market. We're probably getting closer to the end of this massive inflationary cycle. And it's not that we're going to get deflationary movements, but more along the lines of just stagnation at that level. And then when you look at the CPI, the month over month, that's what we keep talking about, where the trend for CPI remains elevated. Like, I'm not saying it's not going to continue to go up, but the biggest shift has really been in the 1 year expectation of moving it going up 1 point to 4.6%, and then expectation over the 5 to 10 years to still be at about 3.1%, but it's still well over the target of the Fed. So you have all of this liquidity just sitting there, and if the economy really starts to pick up, then you're going to compete against this velocity of money, which then could become a different type of overhang in terms of the movement of capital through the system, which would then be inflationary in its own right. Now, while all of this is happening on the consumer side, as we talked about with prices and manufacturing and that movement through, it's also been obviously happening in the real estate market. So then when you look at the Conference Board's consumer confidence, so May came in at 117.2 with the estimate at 119, still a positive movement, but below estimates. But the and present situation has gotten better up to 144 versus the 131. But expectations going forward have declined. So when you look at that orange one, so when you look at the blue, it's gone straight up. That has gotten better. Things in terms of where things sit right now have kind of flatlined, but expectations for the future have worsened. And that's where we keep getting this concern of if the consumer, the underlying consumer, is getting a bit more cautious, that's going to change spending behavior. That's going to change movements. And that's why we think there's something to watch. Now, when we go back in time, you can see that it's still elevated versus where we were in 2019, 2018. So it's not like things have gotten exponentially worse. This is just something that should give everybody a pause and really dig into the numbers a bit differently. And this is just an example of vacations. So we talked about this in the EIA show, but it's interesting because right now vacations intended are obviously up, but they're still depressed. And this is where I know there's a mantra of the great reopening. Everybody's pent up demand. Everybody wants to get out of the house and go do things and visit, but a lot of people don't have money, or don't have the money they did have, or don't expect to have the money they have today. And that's going to cap some of this resurgence that I think the market has really priced in to perfection. And there's a lot of downside risk, and this is just using one of those examples of where we could get some of that downside risk in general. And then when we look at U.S. employment since January 2020 by wage level, this speaks to just the low income side. Middle income continues to struggle. High income has gotten back to essentially some sort of normalcy, but we see this pressure remaining in the low income front. And unfortunately, this is where we continue to see that pressure point, because the low income, even though we've broken this has been broken out into 3 different segments. This underlying piece is what is actually become a larger part of the U.S. population, and is going to lead to, well, can they really travel? What is their rent going to look like? And they continue to get priced out of the ability of buying a home, because the prices just continue to move up at an astronomical pace. And that's where we start to look at, well, what type of wages? Where are we seeing different things in general happening? So production and non-supervisory employees, obviously leisure and hospitality had that big surge, as we talked about in March into April. But retail's come back. But now we've started to see some of the amount of slowdowns in terms of just that percentages. And the reservation wage, so lowest wage respondent would be willing to accept for a new job. So income above 60,000, they'd be willing to accept a lower wage. Where income below below 60,000, they'd be willing to just get back to work. And we saw that in the recent numbers, but those who are making over 60,000 wouldn't be willing. And I think that's interesting because the problem is people, obviously, making more than 60,000, you have a higher cost of living. You probably have a bigger apartment, a nicer car, which means a bigger car payment. These are things that weigh on how much slack do you have in. Then if you layer that in with rising costs or wanting to buy a home or save up for a home, that means that you're going to be less willing to take that discount. But when we talk about housing, it's important to understand, what that means for CPI, because housing is 42.4% of the CPI index. And housing, because of the way it's calculated, has grossly underperformed on a year-over-year, month-over-month level, and that's now coming to an end. Now, transportation, we talk about in the EIA show, gasoline prices, diesel prices, that's gone up, jet fuel prices. The bigger, so essentially from medical care over, is going higher still. And again, that's why we think, and especially the biggest piece of it is set to go up again, which is going to be the biggest issue for the underlying data points. And this is just an example. So house price inflation. So S&P Case-Schiller Composite 20 back up, up now 13.2% year over year, month over month, continuing to trend higher. Again, we continue to see this going up higher and higher, because when you think of the year over year, we never really got deflation in 2020. So it's not like we're coming from this massively low base, because 2019 prices were low, and now you're just seeing the steady move up. So 10 city composite is up 12.8%, 20 city composite is up 13.3%. 10th month of accelerating home prices, and it's the highest since December of 2005. Now, remember what 06, 07, 08 looked like. Now, the FHFA, you can see, again, all of them are pointing up. Now, while all of this house price inflation continues to shift higher, there's a little bit of a shift now. And this is some of the some interesting data that I got from Zonda on Twitter. And I tweeted it. I recommend a follow because it's been fantastic so far. So mortgage rates remain historically low. New home prices have obviously risen rapidly. And I mean, up to the point that they're at over $370,000 for just the median backdrop. Which of the following challenges, if any, is your operation experiencing? And I think the biggest one that's the biggest change is the hesitancy from buyers. And this is what we talked about when we were discussing at what point does the market reject prices? And the hesitancy one is the exact one that we're talking about. Now, we're still seeing houses stay on the market for a record low amount of time. We're still seeing people bid well over asking price, but you're starting to get some of this hesitation baked into the market. And then homes not achieving high enough appraisal values is still at the high at this level of fear that, again, we continue to point to as being some of these bigger issues as the challenges continue to rise. Because when we look at no challenges went from 38% to only 21% as you're starting to see some of these pressure points. Then let's take it to the next level. Are you making any adjustments to your sales strategy in order to better align with your production capacity? Asking the builder. And it's interesting to see because there's taking a pause on reservations, contract sales until construction catches up. Because as we said last week, we're getting this huge shortfall in just the availability of equipment, of materials, which is at the disruptions are at levels from the 1980s to give you an idea of how bad some of the disruptions are. And then when you look at just taking on a specific number of contract sales per month, per project per month, that's really pivoting over to just pausing altogether and just not taking anything new, trying to let everything catch up. And this is one of those reasons on why there's some hesitancy, because the average hourly earnings of production and non-supervisory employees versus the purchase of a home. I mean, I could say a lot. I could sit here and rant. That chart speaks for itself. This is why you get these people that are feeling left behind, the inability of getting a home, moving out of this weird rut of renting versus trying to save up to buy, earning equity, all of the other mantras that we always hear. This is that dichotomy that becomes a bigger problem on a social unrest side, social immobility, inequality. This is the perfect chart that I think encapsulates all of those issues in one. Then when we take it back to a month over month level, let's look at the U.S. home price index, up 1.4%. Seasonally adjusted, quarter over quarter, up 3.5%. 20 city month over month, up 1.6%. 20 city composite year over year, again, that 13.2. So it's not just a base effect. It's not just a year over year. It's a month over month, quarter over quarter. And all of this is going to bleed down into rent, because rents are going to have to marry with what people are buying, because how much of this is being purchased by investors that are going to rent out these new units. Again, the level of problems continue to mount at the housing side, which is why we're seeing some of these slowdowns. U.S. new home sales April were 863,000. Estimate was for 950,000. New home sales month over month are down 5.9%. Estimate was for down 7%. Median home price again at $372,000. So you're starting to see some slowdowns, but there's still slowdowns, but not to the levels that were expected. Mortgages, I'm just going to pull up because some of the data did come out again today. So the MBA mortgage applications are down 4.2% for May, but we're also coming into a seasonal period where typically we start to see May into June and July. Summer is that housing period, so that's where we're going to have to look to see, do we get some of this reversal in general. So, but again, you're still seeing some of these inherent slowdowns in general. So then when we turn to just the backdrop of where are they being sold, so here you can see price increases, the price changes across the board. There's year over year, month over month. It doesn't matter. It's happening everywhere, even though some areas, specifically parts of New York and California, are actually seeing an increase in inventory, but also seeing price increases. So that's going to be an interesting one to shake out, as New York and California have always been in their own little bubble. So then when we look at those U.S. existing home sales, a miss for April, existing home sales. So you had new home sales now existing. We're down 2.7% versus an estimate of up 1%. And we're down 3.7% in the prior month, which is the third straight decline and level now at lowest since last summer. But meeting the median selling on this side, so the price was up 19.1% year over year to 341,600, record for both data points. Only 1.16 million homes for sale at the end of April, which is down 20.5%. So you're still short on supply. So that's why you're still seeing some of that price hold in, but you're starting to see some of this pause. Like, can I afford this? Like, rates they've gone up a little bit, not a lot, but this is where you're starting to get to this friction point, because people are getting priced out of the home now in this competition. And then if you do win, some of these individuals are stretching what's already available based on their down payment. And this is where you're getting some of these additional pain points. And this is where, again, speaking to just the level, because the 19.1%, the highest during peak financial crisis was 16.6% in 2005. So we have now taken out the high achieved in 2005. But then the Fed will sit there and say, but we don't see a problem. There is no inflation. There is no issue. There's no problem in the housing market. Yeah. Okay. So then when we look at home sale prices, this is talking to where we continue to see these 4-week rolling averages. So home sale prices, again, up that 24% from 2020. But you don't have the same base effect in 2020, because 2019 was low. Then it was 2020. Now you're at 2021. and you're continuing to see this grind higher. So then when we turn to, the U.S. existing home sales, this is showing where the biggest declines were in all regions except the Midwest. So the Midwest was up 20%, speaking to the shift from urban to suburban to rural, trying to get out of the city and try to get more for your money. Because at the same time, if you're moving from the Northeast, the Midwest, even at elevated prices, looks free. So you're starting to see some of this movement. And again, this is some of those pressures that we continue to see in the market. Now, it's not just in some specific areas, because when you look at the CLO market and the issuance in general, you can see that 2021 is already outpacing where we were in 2020, trying to take advantage of just the amount of liquidity. Banks need to put the money somewhere, as we showed with the RRP, and they're willing to take some of this additional risk, which is why the forecast for 2021 continues to shift higher. We continue to see more and more getting pushed into the market in general. And then when we look at unvaccinated adults, say vaccination requirements for in-person work could sway them. So what would make you get a vaccine for those that haven't gotten a vaccine? Work in person, shop in person, dine in person, fly domestically, send your children to school in person. So I think the work in person, as people start to get told, look, you have to come in 3 days a week, full time, but you're going to need to get vaccinated in accordance, or in order to do that, people may feel the need to get vaccinated, which again is going to be a driving force to get people back into the office and get those vaccine numbers, supporting them, and because they've been slowly declining in the U.S. Where then when we look at the department stores on the weekly foot traffic, I just wanted to highlight, just, given this is just 4 entities, but people still aren't back in the store. Now, some of that is different depending if you're on Home Depot, if you're at Target, a dollar store. But here's where we're seeing, again, some of these changes, because we're still seeing buying, but again, leading more to less foot traffic, more online, just changing the way people are consuming and shifting the buying power. And that's when we start turning to the MBA purchase index, again, coming back to the level of retail real estate buying. And here's where you can kind of get an idea of where the slowdown is, even though we're slowing down, still at record highs. And this is where we have to continue to look at, okay, well, when the furlough, when the foreclosure pause ends, when you start to see more people coming back and getting evicted, or some normalcy, how much of that is going to be a big driver for some normalcy, or just some additional volume on the market, which will be interesting to see. Now in the next segment, we're going to pivot a bit and look at Europe and try to show on how there is some, it does talk back to or speak back to some of the things that we're seeing in the U.S. as well, because we are seeing that shift in the way people are consuming. So we'll try to make that connection. If you have any questions, please obviously let us know.